Closing that old credit card you never use could drop your score by 50 points or more. Almost everyone thinks closing unused cards is the responsible thing to do. It's not. Here's the weird part. The card doesn't even have to be misused for this to hurt you. Simply closing it can quietly damage a number that decides whether your next loan gets approved, and at what interest rate. In this video, we're not just going to define what a credit score is. We're going to break down exactly how it's calculated, the real factors that move it up or down, and bust a few myths most people genuinely believe. And stay with me, because halfway through, there's a quick test to see if you actually know which of your habits are helping your score and which ones are quietly hurting it. Here's your number. In India, your CIBIL score runs from 300 to 900. Anything about 750 is generally considered strong, and it's the difference between getting approved instantly and getting rejected or approved but at a noticeably higher interest rate. So how is this number actually built? Credit scoring models, the kind FICO built globally and the kind Indian bureaus like CIBIL are structured similarly around, break your score into 5 weighted factors. Payment history carries the most weight, roughly 35%. This is simply whether you pay on time, every time. Credit utilization comes next, around 30%. How much of your available credit you're actually using. Length of credit history matters too, around 15%. How long your accounts have existed. Then credit mix, about 10%, meaning a healthy variety of loans and cards. And finally, new credit inquiries, another 10%. How often you're applying for new credit. Now go back to that old card you're thinking of closing. Closing it does two things at once, and both work against you. It shortens your average credit history length, and it reduces your total available credit, which instantly pushes your utilization ratio higher on your remaining cards, even if you haven't spent a single extra rupee. If you remember our video on the credit card minimum due trap, that connects directly to the biggest factor here. Paying at least on time every single month protects 35% of your score. But paying only the minimum while your balance stays high also keeps your utilization elevated, which quietly damages the second biggest factor at the exact same time. Time for that quick test. You have an old credit card. Zero balance, no annual fee. You haven't used it in 2 years. Do you think closing it helps your score, hurts it, or does nothing at all? Drop your honest guess in the comments before I tell you what actually happens. If you guessed it helps, you're not alone, and that instinct makes complete sense. It just happens to be backwards. Here's the real strategy, and it's simpler than most people expect. Step 1. Keep old, unused cards open, especially ones with no annual fee. They cost you nothing to hold, and they quietly protect both your history length and your utilization ratio. Step 2. Keep your utilization under 30% of your total limit on every card, ideally lower. If your limit is 1 lakh rupees, try to stay under 30,000 in outstanding balance at any time. Step 3. Space out new credit applications. Every hard inquiry dings your score slightly, and several in a short window signals risk to lenders, even if you're managing your money perfectly fine. And here's one more myth worth killing right now. Checking your own credit score does not hurt it. That's called a soft inquiry, and it's completely different from a lender pulling your file, which is a hard inquiry. Check your score for free, regularly, through your bank's app or CIBIL's own website. Most people avoid checking simply because they are scared to look. And that fear is exactly what lets small, fixable problems quietly snowball for years. Your credit score isn't a mysterious number some bank invented to judge you. It's a scorecard built entirely from habits you already control. You just haven't been shown the actual weights behind it, until now. If you want more no-nonsense breakdowns like this, subscribe to InvestR.